Darin Turner, let's talk about some of your favorite MLPs over at Invesco. And we'll start off with Rice Midstream, which is up around 80% so far this year. Now, Rice Energy, the parent company, recently bought Vantage Energy for about $3 billion. So what does this mean for Rice Midstream?
Sure. So Rice Midstream, the big benefit they're going to get is it greatly expands their midstream operations. So from a gathering and processing standpoint, 100% natural gas focus, they're basically going to be doubling the size of their portfolio over the next 5 years. Expectations are that they can grow cash flows now by about 20% through 2023. So even though it pays a 4% dividend, which we think is attractive, it's really a growth stock on why people are looking to Rice Midstream today.
And they're up in the Marcellus and the Barnett, but let's go a little bit further down to Dallas because you like Energy Transfer. That stock's, I think, up around 20 or so% so far this year, pays around 11% yield. Talk about how consolidation is going to affect Energy Transfer Partners.
Sure. One of the knocks on Energy Transfer Partners has been it's too complicated of a story. So you have a parent, Energy Transfer Equity, you have Energy Transfer Partners, and then you also have Sunoco Logistics in the structure as well. One of the things that you've seen them do is that they continue to consolidate the structures. They bought Regency about 2 years ago. So they're trying to simplify and then let investors understand and be able to underwrite their business going forward. Now, when we look at the market today, Energy Transfer Partners is one of the cheapest MLPs that we see. So dividend yield north of 11%, price to cash flow of around 9 times. We think that dividend is 100% safe, so we see no issues with them actually continuing to grow their cash flows moving forward. And in addition to that, you saw it with Sunoco Logistics, they do have the ability to still go out and do new acquisitions, which should also help their cash flow going forward.
All right, another MLP you're watching is Plains All American. Plains was at $60 a share about 2 years ago. Now it's at $30. Can it get back up to $60?
The real driver for Plains All American is the Permian, which is one of the reasons that we like it today. So when we look at the economics of drilling for oil in America, the Permian is the #1 place that you want to be from an E&P standpoint. Now, Plains controlling the majority of pipelines in that area, any increases in production out of the Permian is going to directly benefit Plains and, again, help their cash flow at the end of the day. Now, when you look at production across the country, yes, U.S. production is down, but Permian production is actually higher today than it was in 2014. So still a very long runway of increasing production, again, benefiting Plains long term.
All right, and then from the Williams Partners, a lot going on at Williams and Williams Companies. So is this an acquirer? Are they going to be acquired? What's your outlook for Williams?
Yeah, so definitely Williams is in the news every other day, potentially being discussed about being acquired. You had Energy Transfer and most recently Enterprise Product Partners. Why people are looking at Williams and why we do think they're more likely to be acquired is that they own the Transco pipeline, which is on the Atlantic coast, natural gas focused. It is absolutely one of the best pipelines in America. And so what people are trying to do is be able to acquire that pipeline and then build additional pipelines off of that to, again, feed utilities on the East Coast. And so when we think about their asset base, again, we think Williams has one of the best asset footprints in America today.
All right, thanks a lot, Darin, for coming to talk about it.
Thank you very much.
And thank you for watching The Street.